Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Thursday everybody. China's Labor Day or May Day holiday has now ended and the country is back to work. For today's episode, let's begin with salient economic and financial updates. This quarter may very well be characterized by the concept of mixed messages. It seems like one day we receive positive news of China's economic recovery, just to receive concerning news the next day. This is increasingly pointing to the fact that investors, businesses and policymakers all may need to be prepared for a roller coaster ride these next few months, as what increasingly appears to be a lopsided recovery is emerging. We remember that in a surprise development, which has already spooked markets. According to official data published by the National Bureau of Statistics, China's manufacturing sector contracted in April. The Purchasing Managers' Index, PMI, for manufacturing fell to 49.2 in April from 51.9 in March. And there were not many bright spots in the data either. Sub-indices for new orders, new export orders, manufacturing equipment were all below 50, representing a contraction. Then today, Thursday, Chinese financial media outlet Caixin published its own so-called Caixin China General Manufacturing Purchasing Managers Index, which seeks to give a more independent snapshot of the country's manufacturing sector. And this index reinforced the official position that China's manufacturing indeed saw contraction last month. As we can see, the Caixin PMI fell for the second straight month in April, dropping to 49.5 from 50 the previous month, and 51.6 in February. With its publication today, the analysts behind the index express, quote, "The decline in the PMI reading underscores the concern of China's leaders about the sustainability of the economic rebound seen in first quarter GDP data." End quote. Wang Zhe, senior economist at Caixin Inside Group, which puts the index together, warns today, quote, "It remains to be seen if the rebound is sustainable after a short-term release of pent-up demand." End quote. Adding, quote, "Recently, deflation has become a hot topic in the market. Relevant policies should focus on expanding domestic demand, stabilizing employment, and improving expectations, as well as improving the monetary transmission mechanism to form a virtuous cycle of economic development." End quote. In the first quarter of this year, manufacturing accounted for 27.9% of China's GDP. Next up, in capital markets, some investors are turning pessimistic towards the Chinese economy. According to IHS market data, in the last 6 weeks, short selling of the Vanguard FTSE Emerging Markets ETF, which tracks an index heavy on Chinese A shares, surged to $1.12 billion, indicating that investors are betting that the Chinese stocks will lose value. This leaves it the most shorted since the Shanghai lockdown last year, during the darkest days of zero COVID. Despite China's opening up, initial market enthusiasm, and, on balance, positive official Q1 performance numbers, emerging markets, dominated by Chinese stocks, have seen a $500 billion sell-off since January this year. United States investor interest in Chinese stocks specifically has dampened significantly after hitting a record late last year, likely driven in part by political and geopolitical concerns. As we can see here, trading in the most liquid US-listed options that track Chinese stocks has more than halved since hitting a record last November. Quote, "Many investors have been responding to the escalating tensions by seeking funds that would invest in emerging markets but exclude China. The risk of sanctions together with the risk of regulation by the Chinese government all pushed in the same direction to investors wanting exposure to emerging markets ex-China." End quote. Some commentators also argue that this trend is also due in part to China steadily cutting off international access to various databases, including corporate registration, industrial and financial information. Quote, one can see why Beijing is feeling sensitive. Apart from real-time financial information, comprehensive databases on the economy make it convenient for those who want to study just how dire China's municipal financing is, or the true state of its industrial sector. As such, it has become increasingly difficult for people offshore, even those of us living in Hong Kong, to find out what China or its companies are up to. This explains why many long-only global funds have been sitting on the sidelines despite China's grand reopening late last year. Investing in China from thousands of miles away is increasingly a losing trade. End quote. Next up, Huawei. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit the like button. It's a huge help. It is just me making these episodes every day. It's a lot of work, but with your guys' support, sharing and subscribing, it's a huge source of inspiration. Anyone who can go the extra mile and help me keep the channel financially sustainable and primarily subscriber supported, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. Shenzhen-based technology giant Huawei has reported flat revenue growth in the first quarter of 2023, as it struggles to mitigate the effects of a crippling US campaign that has limited supplies of handset chips made with American technology to the Chinese tech giant, in the words of one analyst. We remember that since 2019, Washington, citing national security concerns, has barred American suppliers from selling to Huawei without export licenses and prevented the company from using any US technology for chip design and manufacturing. According to a recent statement from the company, the firm made $20 billion in sales in Q1, up just 0.8% year-on-year. The net profit margin was 2.3%, down from 4.3% in the same period last year. One of the key reasons Huawei is still standing is that it has received strong government support. UK-based Financial Times reports that Beijing awarded Huawei government grants worth almost $1 billion in 2022, double versus the previous year. Conditional funding tied to specific research projects tripled from that seen in 2021. Perhaps sensitive to the attention this kind of massive government funding attracts, the company said in a recent statement, quote, government support for high-tech research programs is par for the course in most countries. Huawei is no different from other companies in the industry that apply for this kind of support. End quote. When we look at the level of resources Huawei pours into research and development for advanced technology, a space that PRC leadership has prioritized, we start to appreciate just why Beijing is so committed to keeping Huawei afloat. Due in large part to US sanctions, Huawei is furiously developing alternatives and replacements for Western technology, not just for itself, but also for other Chinese firms, like Shanghai Microelectronics Equipment, for example, which has been affected by Western restrictions. Chinese financial media outlet Yicai, in a report this week, cites an unnamed China-based analyst as expressing, quote, hardware components that used to be sourced from foreign companies, such as chips-related technology, still remain a core element for many companies. So Huawei must invest in developing hardware alternatives on all fronts. End quote. According to a report published by CITIC Securities earlier this year, in the 2 years, 2021 through 2022, 4 in 5 of the 24 Chinese cities which built artificial intelligence computing centers used Huawei chips. Huawei, though bruised and battered, appears to still be going, and morale, at least publicly, appears decent too. Speaking at an event at the Huawei Work Campus last month, a Huawei board member and president of the IT management department expressed to a cheering crowd, quote, today we are proud to announce that we have broken through the blockade. We have survived. End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Thursday wherever you are, and I will see you all tomorrow.